So here's the problem. What should we do when markets offer low returns? And I'm going to share some thoughts on evidence, and it will reveal some behavioral issues as well. But what I hope to do is to convey an evidence-based perspective against which we can assess our view about the behavioral issues that drive people to behave in particular sorts of ways. Let's just review where we are now. We have a data set that I'll describe later, beginning in 1900 for many assets in many countries. So the interest rate that we look at is one which is today, which is the bottom right of this screen, historically low compared to the last 116 years. And we had thought after the US raised interest rates that Britain would follow suit, and it became clear over the course of less than a year since then that actually Britain was destined to dip down further. And so we have a tiny little further reduction in the interest rate, which only those at the front can probably see. That was the cut from not long ago. And we can compare that to the United States, which is also at record lows. Here I've just put some dots that identify periods of rising and falling interest rates. The gold, I was going to call them gold diamonds. That's the shape if you're at the front. But something funny about the phrase gold diamonds. The gold diamonds mark the beginning of an upward trend in interest rates, and the turquoise diamonds represent a period where interest rates were declining. And here you can see again, if you're at the front, there's a little dip up, and there's continuing discussion about this. And so I will refer a little bit to the environment that we're in for investment as well. The first thing, of course, that you're interested in is purchasing power, so we adjust for inflation. So this graph, the blue line over there, of $1 invested in 1900 being worth in 2016, in terms of purchasing power, 1,271. That's a quite different story, just looking back to the previous slide, from growing to 35,100. That's the impact of inflation. We've stripped out inflation. And then what you've got as the turquoise line on this chart is more like the headline figure you'd see in the Wall Street Journal, which is the capital appreciation. Price indices are what we normally talk about. And so you can see £1, or $1 in this case, invested in the US market would have grown if you had not taken your dividends but had somehow destroyed or wasted them, would have grown to $11 in purchasing power. The difference between the two is the impact from reinvested dividends, which is very large. And you see the same pattern in other countries. For the UK, you can see the same thing. For the UK, the total return in real, inflation-adjusted terms, was 5.4% per year. Capital gains was 0.8% per year, and the gap is to do with inflation. So for these two countries, reinvested dividends represent a large proportion of the total return. Not 100%, but a large amount, 85%. For many countries, capital gains for the headline index were over the long term negative. So in real terms, you lost money in the equity market, but you still got the income. And so for those countries, the real return, as I'll show you, is in every case positive. Capital gains were not. And so in those cases, dividends represent not approaching 100%, but more than 100% of the total return. Because without dividends, you would have lost money in real terms. So let me take those two countries and let me add in a little bit more color. First of all, let's think about risk. This is a stack of years for those sitting at the front, and for those of you at the back, it probably looks like a bar chart. It sort of should. If not, close your eyes a little bit, halfway, and you'll see it. So here we've got the number of years in a particular country where return was between -50 and -40. And the return that we're measuring here is the excess return. This is the amount by which equities gave a return in excess of the Treasury bill rate. It's the reward for risk. And then we've got 5 years, which gave a return between -40 and -30 as their excess return, through to 1 year, which was the very best, giving a return of more than plus 50% higher from equities than from Treasury bills. And you can see in dark one particular year, 2015, is highlighted. That gave a return between -10 and 0 of equities relative to treasury bills or cash. So equities are volatile, and there are periods when people get exuberant about the market where there's a conviction that this volatility doesn't really matter as long as you're holding for several years. So mutual fund investors are often guided to think in terms of 5 years. 5 years is not very long to enable volatility to sort of not matter. And in fact, the longer you are invested, the greater the downside risk might be. So some people think about this as sort of volatility that doesn't matter. Those who might have traveled in the late 1990s to the United States would have encountered taxi drivers who explained how they were going to pay for their daughter's wedding or their son's bar mitzvah, which might be in 5 or 8 or 10 years' time, by putting their money into the equity market, because then they would have enough to meet their needs, which they otherwise couldn't manage. And then the year 2001, 02, we're not quite so happy. There are downsides. So let me show you what happens if you require a risk premium and you think sensibly about the reward that you require for the downside risk of shares, which is not simply vibrating year by year, but can go badly wrong. So here you can see how badly things can go. This is a bar chart showing you the performance of the world index in common currency. So what we've done is to take the market capitalization world index. If we go back to 1900, there wasn't a global equity index fund that you could buy, but this is what it would look like if you could buy a cost-free global index fund and continue to hold it all the way through. For example, on the left, you can see World War I. So the real returns, inflation-adjusted returns, were negative, although not hugely. You can see World War II. I'm looking at periods of trauma here. The Wall Street crash obviously was a pretty bad time for world markets. You can see the oil shock of the 1970s, the internet bust, the credit crash. That's for the world. Now let me show you within the world the country which did the worst. And so after World War I, although equities globally weren't all that affected, it wasn't too hot in Germany if you had your money invested in the equity market. There might have been other things to worry about as well. Same for Japan after World War II. In fact, it's only when you get to these recent 21st century setbacks where there's so much correlation between markets that the very worst country, Germany, which had whose high-tech companies evaporated, or Ireland, which had a very heavy weighting in banks. Those very worst countries weren't very different from the world average. So the world has got a more difficult place in which to diversify. Diversification is technically easier, but it doesn't deliver quite what you would like to see. And it's intriguing to see that at times of trauma, there was not that much downside. It's peacetime markets that are dangerous. The most dangerous time for being in equities is the time where people are confident, as they were in 1999, that growth will continue upwards and that risk has been reduced so that required rates of return are lower while projected growth is higher. And then small changes in growth assumptions or small changes in perceived risk can lead to large movements in the market. So the times when you most expect to have a crash are the times when people think crashes are unlikely. You got it? So if it's 1939, people are all worried. The stock market is already anticipating what might go wrong. But if it's 1999, everybody thought crashes were impossible, and so they were relatively more likely. And there can be very big downsides. This chart is what a hedge fund vendor would call a drawdown chart. It shows you by how much you can lose money from a previous high. And so, for example, you can see that this is for the US stock market. You can see if you've gone into the US market in the late 1920s, you could have lost, in real terms, more than 3/4 of all your money until the market started to turn around. So equities, in terms of cumulative performance, are very risky. This is why I'll go on to say that people will price them to provide them with a reward. There's the same chart for the United States for bonds. It's the same thing, but the timing of the dreadful bond markets was somewhat different. But you would have lost 2/3 of your money if you'd had the misfortune to invest round about the time of the Second World War and to remain invested through periods of unexpectedly high inflation. So you would have gone through the 1970s. I'll just put one on top of the other. There's the two together. And so you can see that the bad times for bond investors are not quite the same as the bad times for equity investors. And here's the same thing for the United Kingdom. For the UK, we can't go quite as far back, but we have daily data beginning in 1930, which we can use for the same story. Here's the stock market. The British experience was at its worst in the mid-1970s. There are a few people in the room who are old enough to remember, if their memories still work. That was what happened when Britain didn't know it had some oil, and oil prices moved against it. Here's what happened to bonds. If you'd had the misfortune to buy in the late 1940s, you would, in purchasing power terms, if you'd bought your bond investments and you paid no tax on the income and no management fees and no nothing, you still would have lost 3/4 of your money, and it would have taken you half a century to get back to achieving a zero real return from government bonds. And put the two together, and you can again see in purchasing power terms, what you're experiencing here is the combination of the volatility of equities, meaning more downside, and the lower long-term returns in real terms from government bonds. And that means that things can go badly wrong with either, and there's scope for diversifying between the two. Now, if there's downsides, where's the risk premium? Well, there are upsides as well. So here's the times when there were real golden ages. On the left, you've got the 1990s tech boom. You've got the recovery after World War I. You've got the expansionary 1980s, the recovery after World War II. And this is the world index, the same as before. That's what I'm showing in blue. Not every country did the same thing. And so if you have a look here, you can see that the United States led the world during the tech bubble on the way up. You can see the recovery after World War I. The recovery after World War II. And I've illustrated it with the most extreme country, in each case on the upside. So Germany had this astonishing 4,094% increase in stock prices over just a decade, in real terms, inflation-adjusted terms. So you can see there are golden ages, and the crucial thing here is that these golden ages for investing are not times where if your IFA says it's a golden time to invest, she's getting it wrong. Because these are miserable times to invest. You would be buying into Germany when it bombed out in 1948. If you'd gone to see your client as an IFA, your client would need some smelling salts to recover from the suggestion that you've made. Or what would it be like in the last decade? It would have been a few years ago going in to say, buy Zimbabwe. It looks really good. Keep a bit of diversification, but put half your money into Zimbabwe. These are horrible investments to make, and that's why, behaviorally, people don't like them, and that's how prices get further depressed. There's more downside, although on average, there will be more upside. There's more downside. In other words, that volatility can work against you. So what is the equity risk premium? We interrogate long-term data. I've got each country here. Only the people at the front can read these descriptions. I'll just read them out so you don't memorize all of this, but it's just giving you a feel for the countries we're talking about. Austria, Italy, Belgium, France, Germany, Portugal, Spain, Japan, Norway. EUR stands for Europe, cap-weighted. WXU stands for the world ex-US. Ireland, Switzerland, Netherlands, world, UK, Finland, Denmark, Canada, Sweden, New Zealand, United States, Australia, and South Africa. And so first of all, let's have a look at how they performed in terms of their equity markets. And so for the world, what we had was an annualized real inflation-adjusted return of 5.0% annualized. Not perhaps as large as the sorts of figures people would have imagined before this kind of data started to be compiled. And I've put numbers on two of them. The US is up here, more than a percentage point higher, and you've got the world ex-US, which is nearly a percentage point lower, so you can see there is some variation. But in all cases, these are real returns, in all cases, equities beat inflation, so they provided a positive real return. Now let's look at Treasury bills, which are in light blue here, and you can see compared to Treasury bills, they did handsomely. And in yellow, you can see long-term government bonds. And so you can see in every case, equities beat long-term government bonds, which in turn had beaten Treasury bills. And this enables us to look a little bit at what the lessons are that we might draw from the long term. If we have a look at the comparison between equity returns and bond returns, there was 3% more per year in the world index, and 4% more if you make a comparison with treasury bills. Our view, you may have a differing view, is that people were somewhat lucky. I mean, we talk about the triumph of the optimist. People were somewhat lucky for investing in equities. And prospectively, for reasons I'll explain in a moment, our projection looking forward would be a little bit more modest than what we've seen historically of 4%. We'd be thinking about 3 to 3.5% as the reward for risk. That is still quite a lot if you are a long-term investor. It doesn't take that long for compound interest to pile up. But the New York taxi driver of 1999 would not have been happy with this sort of number. So what's the equity premium? Historically, 4.2% measured relative to bonds, and about a little over 3% measured relative to treasury bills. So here you can see countries ranked by their equity premium. All of them have an equity premium that's positive, whether measured relative to bonds or relative to bills. These are realized returns. The ones that are highest are either the ones which had the highest expected returns or the ones that were lucky. And we can't disentangle that, and that's why we focus on the world as our measure, which is over here, because that at least gives us a feel for what equities have done overall. So let me now think a little bit about how we take things forward. Earlier on, there was a presentation that focused on 10 years as a horizon. 10 years can be very good, or 10 years can be very bad. And we had a chart earlier on. It's a pity that, what's the name of the presenter earlier on? Yes, Greg. So Greg is not here. But he was suggesting that one might draw comparisons with a 10-year return. And yet on his chart of moving averages, some of them were negative. In other words, the expected return, if you look at just 10 years, is negative. Well, that doesn't make sense. Nobody would invest in equities if you had a projected return that was negative. And then there are other times which look happier. Here's the experience that we have and the behavioral biases that we can get from that. Here is the annualized real return on equities and on bonds, equities in blue, bonds in gray. First of all, for elderly people like me. So I'm one of the baby boomers, and so my lifetime experience is of a United States or Japan or UK or Europe or world which gave you from equities 6 or 7 or 8% annualized in real terms, a handsome return from equities. And if you looked at government bonds, they were typically about 3 or 4% over the same period. And then some of you are the same ages as my children. So what about the children? Let's start in 1980. And here you can see that the story, with the exception of Japan, is very similar for equities, very high returns, but for bonds, much higher than they had been over my lifetime, because bonds had a remarkable period of performing very well as interest rates came down until probably only a few days ago, and hence total returns were higher. My contention is that past performance influences our conditioning, or conditions our thinking and our aspirations. So people like me have the tendency to think back to very large returns. People like younger individuals here may look back on government bond markets and have expectations which are unrealistic. Those are not really opportunities for the future. So let me show you how we put things together with the data that I've just shown you. And this is illustrative because you may want to have a different perspective. But let me just show you. Here's a historical equity real return on the world market. Part of that represents expansion in the price-dividend multiple. You probably talk about price-earnings multiples, but the story would be very, very similar. And that's contributed about 0.5% per year to the long-term performance from investing in equities. Going forward, we can't expect that in the future. We can't expect that multiples will go up and up and up and up and up and up and up indefinitely. So most people would take the view that you can't factor in continued expansion in the price dividend, the price earnings, price to book, or any other measure of prices. Historically, dividends have grown by 0.5% per year in real terms. I will take that as being unusual, as a pleasant surprise, growth higher than might have been expected. So in other words, you would have earned a little bit more than inflation on average across these countries and across these years. I'm going to strip that out. If we strip it out, we end up with a number of 4.1%. In fact, if you do the calculations carefully, that is exactly the same as the average dividend yield that was earned historically. This is not an approximation or an interpretation. It's simply arithmetic. And we could talk about that, if you wish, later. So historically, the average dividend yield, if we deduct the Treasury bill return, has given us the equity risk premium. So that equity risk premium that I'm talking about here, 3.1% historically, is what, if we adjust for the expansion in multiples and for real dividend growth, is what investors experienced over the last 116 years. So in the top corner, I've just put this down as a conjecture. We can't prove that or disprove it, but it is intriguing, and this is the way that historically people thought about equities, that it was the income premium of one asset compared to another is what provided their superior reward. And because when we adjust the historical real return for these other factors, because we actually get the average income on equities, if we then deduct the average income on cash, that is perhaps the way the Victorians, I looked at Jeanette for a nodding head, Victorians might not have been thinking about total returns, but might have been thinking about the superior income you get from one asset compared to another. Of course, that's a crude and unconditional average. That one would expect that to change over time. I've already given you an illustration how in 1948 in Germany, one might have had prices depressed because people demanded a higher reward for investing in German equities than they would have done 10 years later. So what would you expect for the future? These first two pairs of bars just summarize what I've shown you, the world since 1950 and the world since 1980. If we look forward, what should we expect? And I drew up this chart a little bit ago when we still had positive returns around the world from government bonds. I've recycled this because the message doesn't really change. So these forward-looking returns of a fraction of 1% from the bond markets in different countries are simply the redemption yields that we'll get from these different assets. And then I've added on, in each case, the equity premium that we would project. And so you can see we would expect, because of the lower equity premium, a much lower performance from equities, and bonds, well, in some markets, they offer you zero, not just in the short term, but if you look at a country like Switzerland or Japan, you can look out 15, 20, 30 years into the future, and you'll still get a negative nominal return and a real return, which is projected to be pretty awful. That's the investment challenge. If we think of taking those blue bars on the right, let's suppose you are a US investor, and you invest in equities and bonds. A classic mix would be 60-40. But my numbers are very rounded here. That doesn't really matter. If you took 60% in one, 40% in the other, you'd end up with an expected real return on an equity bond portfolio of about 2%. That is way below what US endowments and US defined benefit plans state in writing to be their return projection. So to conclude, we're in a low return world. It's worth observing, since in the last few days, we've seen an uplift in bond yields, that moving to a high expected return world is not good for us. It is bad. So if we move to a world in which the expected return on fixed income investment is higher, that means we've lost money from fixed income investment. And over the long haul, when you lose money in the bond market, that's not good news for equity markets either. So we don't want to be in a high expected return market, at least not suddenly. If there's a gradual move, that's different. But a marked move, as we've seen in the last couple of days, is not good news. We've seen equities offer what we think is an annualized premium of about 3.5%. An equity bond portfolio offering about 2%. Long-term investors should be trying to benefit from their long horizon. So if you're tolerant of factor risk exposure, portfolio tilts can be appealing, but not if you are constantly doing this jumping in and out of different mutual funds that are engineered to supposedly give you exposure to these factors. Most people overestimate the expected real return. It is hard, at least in today's market, to grow wealth a lot through superior returns. The game is, to a considerable extent, one of conserving wealth, not becoming wealthy. Cost control is now, in this low-return world, much more important than it was. If you thought 10 or 20 years ago that you would make 10% in a year, spending 2% on fees was acceptable. In today's world, that essentially could chew up all of the real return that's available to you.